Requirement D. Write an email to the financial director discussing your concerns in terms of IFRS 7 financial instruments disclosure and IFRS 9 financial instruments relating to the following notes. Okay guys, let's just quickly identify here. We need to include an email. Therefore, immediately what I will do on a new page, indicate that this is my part D, and I will draft my template to, from, regarding, good day, as requested. I have reviewed the financials provided. Please find my concerns attached in Appendix A. I trust that you will find the above comments helpful. Kind regards. Now, I prefer to refer to an appendix because it is important to end your email. And normally, in terms of the communication skills mark, if you don't include this last section, you don't always get your communication skills mark. Therefore, this is your easy marks. Not free, but easy. Okay, then on a new page or beneath that paragraph, indicate that this is now your Appendix A. Right, now let's refer back. Now we have included our email template. We need to touch on IFRS 7 and IFRS 9. In terms of the accounting policies, the financial asset measured at fair value through OCI and our trade and other receivables. 6 marks. Therefore, again guys, how much do you need to write? Most probably 6 full sentences. Guys, where do you start? We need to start with our theory, apply the theory and conclusion. Correct, incorrect. If incorrect, state why and what is the correct disclosure or note. Okay, now remember, we need to touch on IFRS 7 and IFRS 9. Therefore, I'm going to indicate to myself as a reminder, I need to look at IFRS 7 and IFRS 9. Right, let's refer back to our scenario. Okay, so the first paragraph here at the top, a bit of background info, and then our non-current assets. We have our financial assets measured at fair value through OCI, note 4, financial assets measured at amortized cost. Now guys, we've already touched on this in the previous requirement. And then we have our trade and other receivables. But first, we need to talk about our accounting policies. When we look at the requirement, it states our accounting policies. Okay, they indicate us trade receivables only consists of day-to-day trade receivables and does not contain a significant financing component. Okay, so immediately we have identified during our reading time that they charge interest. Now this does not make sense because there's no significant financing component. Therefore, I'm going to draft this down. I've included a heading, accounting policy, in terms of trade receivables and allowances for credit losses. And I've included the policy should not include interest as there is no significant financing component. Right, okay, now when we refer back, I'm going to tick this off guys, I have touched on this, right? Now in terms of our allowance for credit losses, the allowance for credit losses is assessed each year based on the following. If the credit risk has not increased significantly, 12 months expected credit losses are used. If the credit risk increased significantly, the loss allowance will be equal to our lifetime expected credit losses. Now, when you refer to our principles on our revision page, I think this is about page 3 or so, we have identified our trade receivables will be based on our simplified approach, the impairment. And then when there is no significant financing component, our loss allowance should be measured based on the amount equal to our lifetime expected credit losses. Do you see guys? Therefore, it is important in the accounting policy, they have indicated to us, if the risk does not increase, we will use our 12 months. Now this is incorrect, we can't say this. And then they state that if the risk increase significantly, we will use our lifetime expected credit loss. This is also irrelevant actually guys, because we will use the lifetime expected credit loss because this should be based on our simplified approach. Therefore, we need to include here that this is incorrect, the 12-month expected credit loss. And we need to use a simplified approach. Therefore, they need to correct the accounting policy. I've included our discussion as trade receivables do not contain a significant financing component. The allowance for credit losses is the amount equal to our lifetime expected credit losses, being the simplified approach. And therefore, the policy note should be corrected and exclude the 12-month credit losses component. Okay, so guys, in terms of the accounting policy for trade receivables and allowances for credit losses, we have now discussed our IFRS 9 principles, not yet the IFRS 7 in terms of the disclosure. Okay, so when we refer back to our scenario, we are able to tick off 1.1 and 1.2. Okay, so when we look at number 4, it indicates to us financial assets at fair value through OCI. These investments consist of shares in 2 companies listed on the Johannesburg Stock Exchange. At initial recognition, the entity irrecoverably elected to measure these equity instruments at fair value through OCI in terms of IFRS 9.4.1.4. Both companies declared dividends during the financial year. Okay, great. So we now need to talk about this, but what do we actually say, guys? We need to focus on IFRS 7 and IFRS 9. And let's be honest, you don't know because we didn't study this. Okay, so what I will do is, remember, this is part of the policy still, or no, this is a note. Sorry, I'm lying to you. This is a note because when we look at the extract financial assets measured at fair value through OCI, note 4. This is not a policy, it's a note. Apologies, guys. Okay, now let's view IFRS 7, the contents page, because obviously in terms of a note, we need to include a little bit more detail because, guys, they are able to indicate to us the total at the top, which is 600,000. But out of what does this really consist out of? We know that this relates to 2 companies, but which companies? Okay, we know that they declare dividends. How much? Okay, now this is part of disclosure. Therefore, we will open our IFRS 7 contents page, already flagged. And this is a note included in our statement of financial position. Therefore, I will identify statement of financial position, paragraph 8. Right, I'm going to open paragraph 8. And then I am going to scan through paragraph 8 and identify in terms of all of the different headings. Investments in equity instruments designated at fair value through OCI. In terms of paragraph 11A, what should we disclose? An entity has designated investments in equity instruments to be measured at fair value through OCI as permitted by paragraph 5.7.5 of IFRS 9. It shall disclose which investments in equity instruments have been designated to be measured at fair value through OCI. The reasons for using this presentation alternative. C. The fair value of each such investment at the end of reporting period. D. Dividends recognized during the period, showing separately those related to investment derecognized during the reporting period and those related to investment held at the end of the reporting period. And E. Any transfers of cumulative gain or losses within equity. So guys, if we look at the information provided, they have not really disclosed any of this. Therefore, this is our discussion points. On the left side, I have included the things that we need to discuss, apply, guys, in terms of the financial asset at fair value through OCI. When we look at A, which investments in equity have been designated to be measured at fair value? Now, when we refer to the scenario, we are able to identify that GreenDoor did not provide us with names in terms of the entities. Yes, they've indicated that there's 2 and that they are listed on the JSE, but we don't have any names. In terms of B, reasons for using this presentation alternative, guys, no reasons were provided. They've just indicated that they have elected this. Therefore, again, application GreenDoor did not provide reasons. C, the fair value of each such investment at the end of the reporting period. We don't have the fair value, we only have the total. Remember, when we look at the scenario, they've indicated to us that there is 2. We know the total in terms of the extract above is 600,000, but we do not know the fair value of each of these investments. Therefore, again, guys, they did not provide, GreenDoor did not provide us with a fair value. Okay, D, dividends recognized during the year showing separately the related to investments derecognized during the reporting period and those related to investments held at the end of the period. Because they've indicated to us that there is dividends, because they didn't indicate to us the details. Therefore, there's no detailed disclosure in terms of the investments, dividends received. Okay, GreenDoor did not provide disclosure in terms of the dividends. Right, and then E relates to transfers, guys. They didn't indicate that there's any transfers. In the solution, you will identify that they didn't actually touch on this one, because when we look at the scenario, they don't talk about selling or anything. But guys, my opinion, the information here, it consists out of 2, but we don't know. At the beginning of the year, there might have been 3. Therefore, I will still apply this one. Right, there's no information about any transfers. GreenDoor did not provide information about transfers. Did not provide info in terms of transfers. Okay, now, therefore, when we now look at IFRS 7, IFRS 9, we have now touched on IFRS 7. Guys, in terms of IFRS 9, nothing really, because they have indicated to us the business model, the classification, and so forth. We just don't have the details in terms of our disclosure. Okay, now we need to move on. When we refer to our scenario, our next section, I'm going to tick this off, will be financial assets at amortized cost, guys. We have touched on this in the previous requirement. We need to talk about our trade and other receivables, right? We have an opening balance, we have the allowance for credit losses, the 40,000, and we have a closing balance. Okay, but guys, when you look at this and you think about our examples, it feels like we are actually missing something in terms of the allowance for credit losses. Do you remember that we have to include a recon where we have an opening balance, the movements, and a closing balance? Therefore, we are able to identify that there is no recon, and they need to provide us with a recon. I've included heading trade and other receivables. Okay, so GreenDoor need to explain the changes in the loss allowance and the reasons for those changes. An entity shall provide by class of financial instruments a reconciliation from the opening balance to the closing balance of the loss allowance in a table, showing separately the changes during the period for the loss allowance measured at an amount equal to lifetime expected credit losses for trade receivables, contract assets, and lease receivables for which the loss allowance is measured in accordance with these paragraphs. Okay, so guys, if you have included that GreenDoor need to explain the changes and provide a reconciliation of opening to closing balances, and hopefully you would remember in a table, that should be sufficient. And then that no recon were performed and that they need to disclose this. Okay, so when you refer to paragraph 35G, there's additional disclosure. Okay, but before we look at this, I just quickly want to talk about the allowance for credit losses. Now, let's imagine that you have an investment in GreenDoor and you look at the annual financial statements and you identify that there is loss allowances. Would you like to know how did they get to this? Yes. Or let's say, for example, you are auditing the trade and other receivables and they provide you with a loss allowance. Would you like to know how did they get to the amount? What is the assumptions? What is the inputs? How did they estimate the 40,000? Yes. Now, where is this information, guys? They did not provide this to us. When we look at paragraph 35G, which I know, guys, you can't know everything. We're just human. An entity shall explain the inputs, assumptions, and estimation techniques used. That's why I try to indicate to you. And I know when you write the test, you are stressed, therefore you might miss this. But always put yourself in auditing position or you have the investment in this entity and think, what do you know or what do you want to know from this section, trade and other receivables? I want to know, how did they calculate this 40,000? What is the input? What is the estimations? And therefore we are able to include that GreenDoor did not provide us with any inputs, assumptions, or estimation techniques.